As a letting agent, we are often asked for advice on lots and lots of topics, from tax to insurance to succession planning, power of attorneys, as well as property-related issues as well, such as tenancies and maintenance and things like that. Now, although we cannot give direct advice on all of these topics, we can generally give a good oversight of the key issues a landlord needs to be thinking about, and we can raise a number of questions for our clients for them to then pose to a professional person to seek more independent advice on that. And as an agency, we have a really good network of professional advisors that we're happy to refer our clients to. And one of them is here with me today, which is Morag Watson, a partner with Scott Moncrief, an accountancy firm based in Edinburgh. So welcome here today, Morag. Morag and I met through our involvement with the Edinburgh Care Forum, and we often find ourselves talking about property and tax specific issues. And these days, tax considerations play an ever more important role, an ever-changing role, and I understand that no one size will fit everybody. But there have been some recent changes, such as the phasing out of mortgage interest relief, the introduction of additional dwelling supplements and things like that, that have led to some of our clients buying new properties using limited company structures. And I was wondering if we could perhaps chat about that, the pros and cons, and also whether or not a client who's already got a property, say, in their own names, should think about moving it into a limited company. Is that something you're seeing quite a lot of now?
We're certainly seeing clients looking to set up companies to buy new properties. I think some of the tax implications of transferring existing properties into companies means that we've seen less of that.
Okay.
But certainly new companies for new properties has been something that we've seen more of, particularly now as we're into year 3 of the mortgage interest reduction. So some of the challenges there tend to be, if you have a new entity, how are you going to fund that?
Yeah.
So if the individual buyer has cash that they can introduce into the company, that works very well. If, however, they're looking for borrowing, banks are less keen to lend to brand new entities, so they are more likely to lend to the individual
on a buy-to-let type mortgage.
And then they can introduce that into the company.
Oh, okay.
So they effectively create a director's loan between themselves and the company. The company can then purchase the property, and obviously all the rental income then goes in there, all the expenses go through the profit and loss for the company, and it works very well. From the point of view of scale, I think having only one property in a company is possibly a little bit on the expensive side.
Why is that?
Really because, the company is expected to do filings both with Companies House, it needs its annual accounts, it needs its corporation tax return. You would have to be generating quite significant levels of rental income to really make that worthwhile. I think if you've got 2 or 3 properties that you might be buying, then that's certainly a really good place to put them. The other issue is, how much do you need the money out of the company? So if it's, for example, something that can just sit there, it can generate the rental income, and you don't really want anything out immediately, then it's probably a great place to have it. If you're looking to effectively live on some of that income, then you have the tax charge on the company's profits, but then you've also got to extract that income from there. So the 2 ways that you would tend to do that are either by salary or by dividend, both of which then have personal tax implications, which can become expensive. So it really depends on exactly how much you need to use the income that's been generated from those properties, whether a company actually ticks all the boxes or not.
Right, okay.
For the existing properties, I think you have the issue that it depends how long they've been held. There are potentially large capital gains built into those properties. Now, it is possible, although this is slightly questionable, it's possible that the revenue might accept that if you are transferring a portfolio of properties into a company, you are effectively transferring a business, and therefore you can potentially move that gain effectively into the company and not pay tax on it.
Right.
Now, I say it's questionable because I'm aware that HMRC have picked up on a few of these. At the time when mortgage interest relief was first being reduced, there were a number of people who went through this, these hoops of putting it into the company. And I know now, 2 or 3 years later, the revenue are beginning to look at these and actually question whether that relief is really due on letting property.
Yes, okay.
So I would treat that with a slight element of caution, I have to say.
And it's right, isn't it, that if you're moving a property from your personal name, maybe a husband and wife own a property or a single name, and you're moving it into a company, you're effectively the person selling your property to the company.
Yes.
And so the company would then need to pay the additional dwelling supplement of 4%, isn't it?
Yes.
On its way in.
Yes.
So I guess one of my thoughts have been that when clients have looked at this, they said, well, hang on, I might be realising a capital gain. I've held this property for, say, 10, 15 years, it's gone up in value. So gosh, actually I've got a capital gains tax bill, and if it's only the one property, that potential relief you were talking about wouldn't work. So you're realising that tax burden, you're moving it into a limited company where the company is paying additional dwelling supplement, and the access to finance is certainly opening up now, but it's not as easy as borrowing your own name. So true. I can see why people aren't automatically moving their properties into a limited company.
Yes. I think there was a misconception for a period of time, and it possibly still exists, that actually having this through a company would avoid the ADS, and it's clearly not the case. ADS is designed for people who either have more than one residence or where there is a purchase by what the revenue call a non-natural person, so that can be a trust or a limited company. So we can't avoid it simply by having the asset within a company structure.
Right, no, absolutely. And then in terms of the mortgage interest relief, say you have your limited company and you've not really geared another personal asset to put the money in to buy the property. So say you're going to buy a property through a company, but you're going to get some kind of debt, mortgage lending on it. My understanding is the advantages of doing that through a limited company, although perhaps you may not get the same loan to value, the interest cost may be a little bit more, the loan agreements and the security might cost a little bit more, you can then offset the interest cost as a legitimate business expense. So
That's
not
correct.
going to be, because can you maybe just explain for our listeners, what this phasing out of mortgage interest relief is? Because I believe it's not phasing out completely, it's only to a certain level, isn't it?
Yes. So about 3 years ago now, HM Revenue and Customs decided that mortgage interest, which used to be 100% deductible from your rental income and then working out your profit,
So business cost,
absolutely, would no longer fall into that category. So over a period of 4 years, they have phased this withdrawal, because obviously taking that out in year one at 100% would have been a significant problem for landlords. So what we're seeing in now year 3 is that against your rental income, you can set 25% of the interest that you've paid directly against the profits, and the remaining 75% becomes something called a tax reducer. So what that means is you work out your profits, taking into account your 25% mortgage interest. For example, if you're a higher rate taxpayer in Scotland, you would then pay your 41% tax on that, work that out. And then from that 41% tax liability, you can deduct 20% of the remaining 75% of the mortgage interest that you've paid.
Right.
So that's your tax reducer bit. You've actually worked out your liability, and then you get to deduct a little bit more that reflects the remaining 75% of the mortgage interest you've paid. But clearly, if you're only getting 20% relief on that, it's not as good as being able to deduct all of it.
Absolutely.
From next year, that will become 0% deducted from your actual rental income, and 100% of your mortgage interest will be this tax reducer. Right. So whatever you pay, you are only going to get 20% relief against your actual tax bill. So for people who are highly geared, that is a significant issue, because they may find that, in the past, their mortgage interest potentially wiped out any profit that they made on their rental income. Now, with nothing deducted in working out the profit, bearing in mind that that profit is added to any other income they have, they may well be paying 41%, or in some cases maybe even 46% tax on that, and they will only get 20% of the mortgage interest relief against that liability. So it's quite a significant change.
Indeed. So in those situations, my understanding is that landlords who have been aware of these changes and who are highly geared have been looking to try and pay down some of their debt, because you might as well just be taxed on actual profits as opposed to profits before there's interest costs. So try and get these interest costs down. So I think some of our landlords have looked to try and get better mortgage deals, reduce the debt, try and get better interest rates. I mean, interest rates are still low, which is really is still really helpful. But you can see why there could be an attraction of any new purchases going through the limited company for that. But equally, as you say, you need to be careful how many properties are you going to be having in this limited company to offset the costs of the reporting and the burden of the reporting, and how do you extract that money now? And I guess in the future as well, what is the end result? And I'm sure you're the same, but one of the things I say to our clients, what's the exit strategy? I know you're coming to me now, and and I want you to stay with Chapman's for a long, long time, and we want to help you. But do you know what the exit strategy is? And most people don't, to be fair. Most people are just surviving, the everyday and just getting on with things.
And the asset that they're actually holding as individuals now is shares in a limited company.
Yes.
So the question is, well, what do you do with those shares? You may at some point decide that actually you do need the funds that are tied up in the company. So one option is to sell the asset from there, so sell the property. You will pay tax on that within the company. You are then left with what we call a money box company, so it's got cash in it. And you can, over a period of time, simply extract dividends from that, which can be done quite tax efficiently. You've also got the issue of, well, what do we do if we continue to hold the shares, and how do we pass them on? So this type of company is an investment company, so it doesn't have terribly many attractions from an inheritance tax point of view, or indeed from a capital gains tax point of view in terms of the shares. So there are considerations there as well.
Absolutely. So in terms, I know if you sell a property that's in your own name, or sometimes if you've got a spouse, it's a good idea to say, gosh, we're selling it, let's put it into both names and sell it, so we can both get our own capital gain tax relief on it. So there's no capital gains tax relief when you're selling a property through a company?
No, there isn't. So the company will simply pay corporation tax on its gain, which currently stands at 19% tax. So it's obviously cheaper than potentially having a residential property that comes in at 28%. But you've still got the issue of then how do you extract the money from there?
So if you're sitting then, if you've got a client who's sitting with a property in their own names, and they thought, do you know what, I don't want to move it into a limited company. I've heard of something recently which has got a really interesting name to it, and hopefully you can tell me a bit more about it, but something called love, favour and affection. Could you maybe tell us a little bit more about that one?
Yes.
So thank you very much for your time today, Morag, and for listening to everybody out there. As you'll know from Chapman's, we always discuss a wide range of issues. And if there's any other burning issues that you'd like us to investigate for you or to talk about, then please do get in touch with us. And equally, if you have any tax-related issues, I'm sure Morag would be delighted for you to get in touch with her, and her contact details will be at the end of this presentation.